Thank you so much for being on the podcast. I know me and Agam have been doing this podcast probably the last, I don't know, for a little bit of time now, and you're one of the few first guests that we have on. I think it's exciting. I know this is Agam. Maybe you want to do an introduction, Agam, for everyone that's listening.
A little bit about Rohit. I happen to connect with him through a mutual connection. He has over 20 years of experience in fintech industry, ranging from working in consulting and working in banks like US Bank and even startups. He has been a great mentor. I have been in touch with him since 4 months, and he has been directing me towards many things in the payment industry. About Daniel, we connected through LinkedIn. Since then, we have been working on this podcast, and it has been great. He is a serial entrepreneur. He successfully developed a company previously and currently working to build justpaid.io. Both of them graduate from YC. He's got great connections in the Bay Area. He has been great help.
Nice. When Agam and I spoke earlier in the year, it was like, this guy doesn't have payments experience, but I am freaking ruining or self-criticizing my decision of like, hey, it doesn't matter if he didn't have payment. Now he's like a payments nerd all of a sudden. So kudos to Agam for doing what he's doing.
Thank you. To kick off things, Rohit, why don't you just walk us through your experience, your journey so far in the fintech industry, and where are you right now?
Sure. First of all, thanks for having me on the podcast, Daniel and Agam. Really appreciate the opportunity. Well, my journey, Agam, you already dated me with 20 years, but the journey literally started, I want to say 2004, when I started as a software engineer, was building retail banking solutions for banks all over the world, specifically in Europe and Middle East. Think of this as when you walk into a branch and you have these branch managers and teller using those black screens. That's where I started, right? And got to learn a lot from ABN AMROs of the world, UBSs of the world, like literally at the ground floor of building these solutions. Spend a lot of late nights doing migration, random stuff that didn't add value. And then quickly realized that wanted to focus on the business side of things, more specifically around generating value for the banks. And came for my MBA in University of California, and then worked for a few years at PricewaterhouseCoopers, primarily with an intent to broaden the knowledge skill set. Didn't go deep, as you can imagine, in consulting, but learned a lot of things pretty quickly. Post that, decided to double down on fintech, financial sector. So as Agam said, led a couple of big teams at US Bank, Bank of the West, even did a brief stint at Capital One. Did launch a bank in China from scratch, so that was cool. And then started dabbling squarely into payments. So used to run product management function at Zelle or Early Warning, and was the lead on the Zelle RTP integration. Pretty happy with that project and how it helped shape the industry. And then for the last 2.5 years, I've been with a startup called link.money as their chief product officer. Basically, Agam, Daniel, responsible for the buck stops with me on a lot of things product. So kind of responsible for product, engineering, and machine learning and AI team here at Link.money. That's the journey. I, on a personal front, happily married almost 9.5 years, going on to 10. So no pressure in April to take my wife to a nice trip. 2 young boys. Yeah, that's about me.
Awesome. I guess a question for you, like you've been in the banking industry quite a while. What would you say some of the most disruptive things you saw happen in the early years, and what nowadays, like do you think is going to happen? So it's two questions in one. It's like, what happened in the past, like that shocked you in like the money space, and then what is like you think that is going to be disruptive, like moving forward?
Like I want to say like 5, 6, 7 years ago, it was all about tailored experiences, right? Oh, US Bank actually launched a completely revamped mobile app 5, 6 years ago, and that used to be a big thing. Oh, I'm going to talk to my customers one-on-one through some sort of algorithmic models. And that was disruptive at that time. Everybody was like high-fiving each other. The banks were getting like a lot of awards around these mobile apps. Even at that time, my viewpoint was, yeah, this is disruptive. This is cool that there is a automated chat bot that could talk to you one-on-one in a personal tone and a voice. If you ask me today, okay, it was like some sort of basic algorithm. Doesn't excite me anymore. What I get excited about, first of all, let's just get it out, not AI for the next few years, right? Especially in banking. What does excite me about what's coming in the shorter horizon is payments and real-time payments. I think selfishly, like, of course, I'm in payments, so I'm going to talk about payments, but US is so far behind, or used to be so far behind in terms of the payment speed that it just boggles my mind. Like, you go to India, UPI, you go to Brazil, BRICS, there's so much happening there. The time for US to embrace real-time payments is now, right? And I get excited just because I know we are not there yet, but we are getting there. Especially ACH been there for like, I don't know, since 70s, and we are still using ACH. Now, the two new networks that I shouldn't say RTP is a new network. RTP has been there for like 5-6 years now as well. Finally, I'm seeing traction, whether it is banks adopting, whether it is fintech like us adopting these new network rails. I think between TCH, RTP, and the FedNow, I think they have laid down the seeds for a frantic adoption and frantic activity in the coming couple of years. And that gets us pumped here at Link Money day in and day out, because we see the potential. What I don't see is a quick path to adoption. And that's where like companies like ours are at forefront to kind of help move the industry towards embracing some of these rails. And specifically, we are focused on e-commerce transactions. I get really excited about just the payments and the real-time aspect of it.
Got it. So RTP. So why do you think there's traction happening with RTP now? Like, what gives you that like validation?
I think some of it is FOMO, I would say. Like a lot of these financial institutions are like, if we don't jump on this bandwagon, our customers are going to start moving, right? Because the customers are also getting knowledgeable about real-time money movement. Like, I can go to Chase, send 10 grand to Agam, happens instantly. So the expectations of our consumers have changed. And frankly, some of it has also to do with like products like Zelle, who under the hood might not necessarily be moving the money real time, but the customer gets a semblance that this is happening real time. These things are good in terms of pushing the financial institutions towards, hey, let's embrace, otherwise we're going to start losing the customers. On the other side, I think this has also become table stakes. When you talk to financial institutions, everybody's talking about RTP. Like, if you're still talking ACH, you are considered like old school, backward, don't know what's happening in payments. So on the FOMO side, it's also like, hey, if you want to have a seat on the table, you better have the latest and the greatest technologies. And last but not the least, I think there is just also some sort of a regulatory push around embracing these payment networks. FedNow coming, I think it's a good thing. It's confusing, but it's a good thing for the financial institution that now you have a government entity that is trying to create a universal real-time payment ecosystem. So it's a combination of all the 3 or 4 things that I just mentioned that is leading to the banks embracing these technologies. And frankly, like, and I use this analogy a lot because I think US is generally 5-6 years behind Europe. PSD, 2P, like all these things happened in 2018, 2019 in Europe. Now the US is catching up. So it's a combination of all of these factors. I would also say like fraud is on a rise in ACH. Like, you can look at the numbers, the fraud is not declining. So a lot of these banks, and like I talk to these executives all the time on the banking side, they hate these pull rails. I don't want to pull money. I want the customers to push the money. I want to do irrevocable funds. the dollar amounts are rising constantly, right? For like the AAV on the transactions constantly rising. While ACH to an extent helps, it is still not irrevocable. It is still easy to dispute a charge. So all of these factors are combining for a case to, hey, let's just move to better, faster, instant rails.
I guess the question is, okay, so you have ACH that was made in the 70s. You have RTP and you have FedNow. You're kind of laying all the pieces out. Why use RTP at all if like the government has FedNow? Like, I know it's kind of been in motion for a while, but like, would that go away at this point? Because that was like an organized, like by corporate America, correct?
Yeah, PCH RTP is like a consortium of all the some of the financial institutions that just came together. You know, Daniel, jokes aside, you should be part of CFPB or some sort of regulatory authority, because we used to ask this question all the time. Like, as a financial institution, why RTP and why not FedNow? Like, let's start with the basic. The irony is both message formats are the same. ISO 20022. If I am a decision maker at, let's say, a financial institution, deciding between RTP and FedNow, what is the difference? On surface, there is no difference. I think, in my humble opinion, there is a case to be made that somehow, because FedNow is going to be way bigger, there is a case to be made that these should just roll up into one entity, including, by the way, like Zelle over RTP. Like, there is no need for industry to create these confusing different payment rails that are trying to do the same thing. There is no difference between RTP and FedNow. Like, and again, like, devil is in the details, but on the surface of it, like, people at FedNow might claim that, oh, we are trying to make it for credit unions, smaller banks, 1-2 branch financial institution. RTP can work the same way. RTP also has a very transparent pricing. What has happened invariably is that typically that happened because this was not a regulatory push to begin with. The banks came together. Now they have invested millions of dollars. And I'm just being conservative when I say millions, like the numbers are crazy. Now this is sunk cost, but nobody wants to recognize the sunk cost. Like, I have invested millions of dollars in this particular rail, and I want to stick to it. And with RTP, the thing is that all the big banks have like pushed so much money into this sinkhole. By the way, I like RTP. Like, I did the Zelle RTP, right? So don't get me wrong. But in hindsight, it would be ideal if it was only one single rail, better for financial institutions and everyone. But because the bigger banks always determine and govern, because there is no regulatory push. Like, you have to understand, unlike Europe, we are not a regulatory driven market. So these banks came together. First, they formed Zelle. A couple of banks came together. They formed Zelle. Now Zelle became, then of course, like Venmos and others came in. And then they said, oh, now we want to move everything real time. Because there is no regulation, let's just set our own ISO messages, start doing RTP. Then FedNow woke up and said, no, we are going to do something because all these big boys in the banks are just doing their own thing. Let's just make something universal. What it has done is create more confusion rather than provide more opportunities. So again, in my opinion, at some point, these entities should just roll into one single entity, whether it is FedNow, whether it is Zelle, whether it is TCH, and provide clarity. It's easier said than done. Like, again, these bigger entities have their own selfish interest around pushing for adoption of a particular rail over the other. Not going to happen anytime soon, but if we had control over this, like, we would just roll them up into one single rail. Also, think about, like, at least what FedNow has done great is they didn't try to create their own message format. It is still following what RTP has done. So there is still some sort of, okay, we are talking about the same messaging structure, right? So if, let's say, financial institution A wants to do RTP, for them to do FedNow is an incremental effort, very minimalistic, right? So we are not talking about, again, millions of dollars on another rail, but it serves no purpose in my mind. It's just the same rail.
I see. So it's really the incentives. RTP can change quick because the private corporations can make change too quick. So there is an incentive that they control it better and more maybe than FedNow may not be totally thought through in some senses. They may make changes down the road and it's up to the government. I mean, I'm just talking through like the way you described it.
Yeah, change is not easy for either of these rails because, and I'll give you a personal example. Like we wanted to add like literally one field in the message. We went all the way high up the chain and the answer was no. So even somebody like RTP cannot pivot. You're talking about like top financial institution. Like it is so hard to convince one person at a bank. Imagine like we're talking about top banks all coming together and reaching a consensus. So the point is not about moving faster. None of them can move faster. Like let's just get it out there. Like advantage that RTP has is a first mover advantage in my mind, right? They've been, I think 2018, 2017 is their year of inception. So they've been there for a long time. All the big banks, because of their ownership, embraced RTP. Like they committed to, and all these big banks are already on RTP network, right? So by virtue of that, there is a significant adoption in terms of the volume for these big financial institutions. FedNow, they are just a participant. So they don't have an incentive per se. Let's talk specific. Let's say I'm Bank of America and Chase. Both of them are RTP enabled. Both of them are on the FedNow ecosystem, but they are owners of RTP. When it comes to Bank of America, Chase transactions between consumers, there is no incentive for them to do FedNow. Why? And the consumer doesn't care. Like us as consumers, we don't even know which rails are being followed. So these banks are going to push RTP because, again, like I'm the owner of RTP, I will push transactions on my network rather than Fed network. What I'll do is, some mom and pop credit union somewhere that is on FedNow, those tiny percentage of transactions, because I cannot send on RTP, I'll send through FedNow. Like, so it's a very, I wouldn't use the word conflict of interest, but there is no reason for them to push things on FedNow when they can just do it RTP.
That's interesting. Yeah, I just want to know about we talked about large corporations like BofA and Chase. What's in like for the small startups or mid-level companies who facilitate payments, and what it means to be on RTP and FedNow?
So this is like I deal with this every day. Like we talk to merchants, and of course merchants hear these keywords and they're like, "Oh, you don't have RTP, you don't have FedNow." I want to clear the air, and a lot of people in knowledge of payment know this, right? There is no way right now in US to enable RTP or FedNow payments for e-commerce transactions, period. For RTP, it is not an approved use case. FedNow, they're working on it, but it's not there. So any company that claims that they support FedNow or RTP does only for payouts. What that effectively means is, if as a fintech, I want to send a collective aggregated amount to a merchant end of the day, I can pay out to them. If I want to pay out, let's say Uber use case, right? If I want to pay out to the drivers, I can do that. I can push money from my merchant bank account. The use case that needs or is begging to be solved is, let's say Agam wants to buy a $50,000 ring for his fiance from Tiffany's. He should be able to go to Tiffany's, authenticate with their bank, and say, I want to push the money to Tiffany's. That is not an approved use case in US on these two rails. Very fundamental. Like that's what we need to solve. There is no fraud happening between let's say me as a fintech and the merchant. The fraud is happening where when I'm trying to get the money from Agam, that's where the fraud happens. And that use case is still begging to be solved. So all the claims around, oh, we support RTP FedNow is on the second leg of the transaction where the money goes to the merchant. That's not where the problem lies. The problem lies in debit pulls from the consumer. It just like explodes my mind to think that the decision makers are at these bigger networks decided that, oh, we are not going to focus on e-commerce, we are going to focus on bill pay and all that stuff because that's easy. Oh, I want to pay my utilities. Okay, fine. Every merchant is asking for it. Every merchant thinks that RTP and FedNow are available. The reality is it's not. I've had so many conversations with these network people, and they understand the frustration. And Daniel, coming back to they can't move fast. Like they have their governance structure set up, who meet every quarter, blah blah blah. And of course, like if you know about these structures, right? Big banks have veto powers, and of course everybody vetoes. Everybody wants to protect their interchange. Like there's so much dynamics playing into enabling something like this. It's not a technical challenge. It's like everybody wants to protect their credit card interchange and all that stuff. So they don't want to approve these use cases. It will take time, but the hope that we see is that folks at these networks realize how important it is for them to enable. FedNow and RTP are kind of going side by side. Like I'm assuming hoping that FedNow will start getting a lot of traction in 2024. So now it's again going to be a little bit of a FOMO on which network bites the bullet first and starts offering something what we want to offer, which is like e-commerce payments through RTP and FedNow. Doesn't exist, ironically.
I think moreover, that's the problem you are solving at link.money, where merchants get opportunity to accept payments by bank. It's not more towards RTP, but debit transfer from their customers. What value do you think it gives to a merchant in that sense, like receiving money as a debit?
So, and this is where like a company like ours come in, right? What we we have tried to model it around Zelle, which is like gives a semblance of real time, even though it is not real time, right? So our product is pay by bank. Think of us as a button on a checkout page at a merchant site where the customer can link the account. And what value we are bringing is we decision the payment real time. And if we say yes to a transaction, then the merchant is off the hook. Think of this as real time as possible in terms of the decisioning. No merchant is, by the way, no merchant is expecting every single transaction to be moved real time. It's going to be a reconciliation nightmare, right? All they are looking for is this, if you say yes to a transaction, is this money coming to me? Yes or no, period. And that's where the hybrid approach for interim, what we have is we facilitate linking of the bank account, right? Compliance with like the NACHA web debit rule and all that. Our AI ML model kicks in that decisions the payment real time, right? So I peek into your bank account. We have built proprietary models that predict the likelihood of success. And then under the hood, we move the money through ACH. So not real-time money movement, but T+1. If you want, we can do T+0 for some of the merchants, like depends. But that's the best as an industry we can do right now in the current confines we have. Like I would personally love to do RTP, consolidate everything on my side, and then again do a RTP payout. Just not feasible. We also offer what's called a link guarantee for certain merchants. And again, that depends on the negotiation with the sales team and the merchant, but we guarantee funds. So in ACH world in general, like NSFs are the biggest reasons for payments not going through. I'm able to predict the likelihood. I'm able to predict the balance when the transaction settles, because again, it's not settling real time. With that in mind, I let the merchant know then and there whether the funds are good or not. And if they are good, even if they're not good, it's on me. Like I take on the liability. So as far as the merchant is concerned, T+1, they're going to get their funds. So we are giving them a semblance of real-time money movement by simulating real-time decisioning and then moving the funds next day. If I had to do a payout same day, easy. Like everybody can do payouts on RTP, right? We just, in none of my merchant conversation, the merchant have said, oh, I need the money now. All they need to know is if the money is coming tomorrow or not. That's all they need to know. And frankly, like I've been in conversation where the finance team is like, it's okay, T+2 guys. Just tell us if the money is coming. Like they are not micromanaged, unless you're talking about a small merchant that actually have a cash flow problem. Like I know Uber in the past was like, because they wanted to do payouts to drivers quickly. I could understand why they would want to do RTP, but otherwise these merchants are like, as long as the money is coming in, T+1 is fine.
So question for you, like, you said a lot. I guess on the corporate side, it sounds like RTP is not taking off, or it is taking off on the corporate side. Sounds like on the personal side.
This is where my knowledge on the like the disbursements is a little bit iffy, but the use, I'll tell you, like, and we have had like some conversations on the corporate side, right? Like think of these insurance companies that are trying to do insurance payouts, like claims that they need to pay out, right? They love RTP. Why? Because what they can do is, hey, here is my bulk $10 million treasury or merchant account. I want to pay 100 claims today. Of course, there are regulations around when these claims need to be paid out, how quickly they need to be paid out. They're like, once the decision has been made, I don't want to wait T+1, T+2, T+3. I don't want to wait for banking holidays. Just do a payout. The risk in these are zero, because we are talking about the money coming from a merchant account, right? And that's where, if you magically get into people who decided which use cases to do first, but like these disbursement use cases, low risk, easier to do, and that's where like all these networks gravitated towards. Like let's just do disbursements, let's just do bill payments. So it is taking traction there, and a lot of these corporate payouts and all are built on certain platforms. These big banks had partnerships with these platforms on the disbursement side, and that's where it's an easy, quick, low-hanging fruit to enable. So it is seeing traction there. And again, just by the virtue of them being bigger platforms, working with bigger bill payers, happening. Like the traction is happening there. It's not consumer-centric in that sense. Like I keep coming back to my, like the gap is consumer payments, not like a B2C payment. B2C is easy. That's why they're doing it. I want C to B. It's high risk. That's where they need to do more. But to answer your question, yeah, I see traction on definitely on the B2C side.
So C to B is hardest.
Yeah, like e-commerce payments. Like I even within C2B, I go to e-commerce payments. Like there is no mechanism today.
So what you mean is like if someone wants to go to a store, right? And they go to that store and they find a toy for their kids. C to B would mean like, how do I do RTP to you instead of using a credit card? Is that what you mean?
Yeah, you cannot.
I see.
Like that's the irony. You just cannot do that payment today.
But if you go to your bank as a consumer, you can do that. So it's it's frictionful is what you're saying. There's no like, no merchants. I see.
Yeah, I can like just to give more examples, right? Like I can go to my Chase banking app and say, I want to pay Daniel, RTP, easy, done. But I'm in my banking app. I want to start with that toy store's website. I cannot do that.
I see. So let's go to Zelle a second. So Zelle came from, it sounds like the banking industry is like as a way to create real RTP. Like why pivot away from Zelle? It kind of feels like an app inside of like every large bank. It's like, oh, I can use Zelle inside of.
Correct. So Zelle, like the history is like a couple of banks came together and said, you know what? Let's create a messaging mechanism like, let's just talk to each other, put a hold on the funds, and we can figure out the money movement later. Like, because again, like if I put a hold on your money, it's as good as it's my money. A couple of banks came together, and then of course other big boys, big banks decided, oh, we need to be part of this too. So 7, 8 banks collectively, I always miss it, like it's 7 or 8, like top 7, 8 institutions in the country said messaging. It was a messaging format to begin with, right? Now, if you peel the layer of what's happening under the hood or used to happen under the hood with Zelle was, I send a proprietary message from bank A to bank B. They put a hold on the funds, and then T+1, T+2, T+3, you pick, the money will move. So the customer gets the money then and there, but the banks are settling it later.
Right.
Because it's ACH, right? Effectively, what that means is the banks are taking on the credit risk to an extent or providing the float of the money, right? And mostly it kind of used to give or take net out, right? Oh, I owe you, you owe me, like the settlement window, whatever, T+1, it happens, right? But effectively, it is still fronting the money by these financial institutions. The reason, and frankly, it works perfectly from a consumer standpoint. It's still very P2P centric. Like, I want to send money to you, you need to send. It's not like, again, e-commerce, nothing, right? It's more of a P2P. I want to say like 90%, 95% are P2P. They have other use cases on disbursements, commercial and all that, but bulk of the focus was P2P. Now, the banks everybody jumped on this fad of, oh, we have RTP. Okay, real-time money movement happening, and all these big banks invested heavily in these rails. Now they're like, what should we do? The creative geniuses decided that, hey, let's just merge these two things. Why even the bank need to front any money? Why don't we just start moving everything real time? So that was the genesis of Zelle over RTP. That's a project that I led when I was at Zelle, where now we said, okay, you know what? If there is a financial institution that is on Zelle and they're also on RTP, then the rail would be Zelle over RTP. From a consumer standpoint, nothing changes. Maybe the only thing I can think of that change was higher limits, because less risky, less fraud, right? But otherwise, there is no reason for consumer experience to change, and it has not changed. My financial institutions have invested so much in RTP. They are also owner of Zelle. It seemed like a natural marriage. Like, let's just do it together. And frankly, like when I was at Zelle, we wanted to actually partner with FedNow. It didn't necessarily work out at that time. If you step back and think about what is Zelle, what value does Zelle bring? It's not ACH. ACH exists due to Nacha, right? Zelle is a directory. It is a database of phone number and email mapped to your bank account number and routing number. They're the biggest database. Every financial institution that is part of the network contributes that data, right? The best solution would have been that Zelle, let's say, becomes the directory for US. Under the hood, it could be ACH. Under the hood could be RTP. Under the hood, it could be FedNow. It didn't materialize that way, like due to powers beyond our control. Like they decided, no, we are going to do our own thing. So naturally, it has changed or morphed into, now you have Zelle over RTP. You have certain banks, or a lot of the banks are not even on RTP, right? So even for Zelle, Daniel, they go Zelle over ACH. So let's say if it's a transaction to be settled between Bank of America and Coastal Credit Union in Palo Alto or Santa Clara, it will fall back to Zelle or ACH. Consumers don't know, consumers don't care. But now somebody like a Bank of America has to deal with, some part of Zelle will come through RTP, some part of Zelle will come through ACH. All of these are recipe for disasters in my mind, frankly. Like, in few years, it is going to become unmanageable. Layer in Zelle over FedNow at some point. It's coming. Like, while these guys are not talking, it's coming, right? So all we are doing, ironically, is adding more complexities on financial institutions, because there is no consensus on how these things should operate in absence of clear regulatory principles or guidance around what rails. So it's just getting mishmash of all these rails. Consumer is happy. Like they get all these different choices. They get Venmos, PayPals, Zelle. Oh, I can send money directly through RTP by putting an account number, routing number. There's so much happening. Consumers are happy. It's the banks who are going to suffer in the long run. Companies like us, what we are like, how we are trying to add value is we want to abstract all of these from our merchants. Right? If you think about the rails, who cares? Who cares? Like it's an ISO message for both FedNow or who cares, right? So what we are going to end up doing once these use cases are approved is we're going to probably have like an orchestration layers that will determine dynamically which rail. We don't even have to ask the merchant. Like we decide based on certain parameters, and we will absolutely support all the rails. It's just, in my mind, unnecessary work, but we can't put the onus and the burden on our merchants to determine whether a transaction should go RTP or FedNow or ACH. Like we control and we help abstract for them. Zelle served its purpose. Like Zelle, and of course, like moving almost $1 trillion a year or something in P2P, it's huge, right? I think there are, like last I checked, 1,000+ institutions on the network. It's going to keep growing. But the amount of work that is needed to enable Zelle is mind-boggling, right? So they are not making it easy. And now all of a sudden you get these FedNows of the world and RTPs of the world. The banks are going to reevaluate, like what's the value of a phone number to bank account mapping? Can I ignore that and just start doing straight up RTP? Because like the bottleneck for RTP adoption is you need an account number, routing number. The chances are that Agam doesn't know your account number, routing number, but he knows your phone. Right? That's where Zelle adds value. But at some point, like if you and Agam have a trusting relationship, Daniel will like, hey, Agam, here is my account number. You don't even have to give me the routing number. I'll just like whatever bank, right? So the banks are reevaluating the need for this mapping or the directory. It would have been cool if all these entities would have come together and said, you know what, I'll be the directory, you be the rails universally. It happened with Zelle RTP. It's not happening right now with Zelle FedNow, and that's why the banks are. I feel like based on what I've heard is a lot of these banks are reevaluating whether they should even enable Zelle or strictly directly go to RTP and FedNow or one of those.
So there's no easy way to, I mean, Zelle is like an easy way to remember your account and routing number is what you're saying. It's a quick hack in a sense, like, hey, I'm going to give you money. This is my account number, my phone number. Is that why it is better in like India? Like you said that they're about 5 years ahead. Like, what is it about India that it's a UPI number is what it's called?
Yeah, it's UPI. Yeah.
Like how do you remember UPI number? Is that your phone number? Like, why is that taken off so well in India?
Yeah, these are like tied either to your like user IDs or names or phone numbers, usernames. They're not necessarily tied to your account number, routing number. I'm sure you can do one-time setup and like reverse it. The reason like rails like UPI have leapfrogged is because day one, the entities there thought about these use cases. They thought about ease of adoption. They thought about how we can target 1.4 billion people, right? Like it was never like an afterthought of, oh, we didn't think about this use case. As I said in the middle of the session, right? Zelle was like, oh, let's just do messaging. They didn't think about the use cases. They think about, oh, I just want to send money to Daniel. Let's just put a hold on his account. Oh, how can I do it? Let's just create a proprietary message. Who cares about standardizing anything? Who cares about other institutions? I'm talking just Bank of America and Wells Fargo as an example. All these other payment rails that are coming up in outside US know what has not worked in countries like US. They also know what has worked in Europe using common sense. They are also being driven by regulations, which is key. like we keep discussing this, and like if only there were regulations around payments in US, things would be so much different. Like, so partially regulation, partially learning from the mistakes that we are doing here, partially also like thinking about use cases ahead of time on why a need for a payment rail. Like, how can you build a payment rail that doesn't solve e-commerce? Like, it's still, we are in 2024, for heaven's sake. Like, come on, guys. Like, they're not thinking about it. Again, something that is so obvious is not being thought through. Plus, again, like, there is no regulatory pressure here for these guys to do it. Like, oh, I'm a big bank, I'll just collaborate. And it's a revolving door in these big banks. Like, today I work for Bank of America, tomorrow I'm at Wells, then I'm at, okay, we'll just do in our group. We don't care about California Coastal. And if it doesn't work for this random credit union, who cares? Like, that's the mindset. And in absence of anything regulatory, yeah, that would be the mindset. Like, these banks basically control how payments work for them, and that's all they care about.
Is there any like hot startup that is disrupting this? And maybe it's PayPal through their apps or someone else. Like, I mean, Square with credit card reader on iPhones was a big disruptor. Like, there were some pretty disruptive things to like help the consumer, but that was also credit cards. It sounds like are a patch, like in a way, like it's not actually the transaction of the money. There's the fees on top. It's almost like it's a patch that they built. All the credit card system is like a security patch in a way, right?
Yeah, yeah. I mean, and selfishly, I would want to say link.money, right? But we are also restricted by the limitation of these rails, the limitation of use case. So anything and everything startups like ours are doing are in a way patchwork, band-aids to the limitation of these rails. Like, if we were given a free hand in terms of technically what is the art of possible, what is being done in Europe, we want to do those things. So all these Venmos, Cash Apps, like, they're all doing the same band-aid on ACH, which is sad. And again, like, that's why you see so much fraud happening on Venmos and Cash Apps of the world. It's just because you can plug one hole here and you open up the other hole all of a sudden there. Unless, in my mind, like, the financial institutions really get motivated somehow, or they get pushed by regulations, I don't see an incentive for them to change things. And they're happy with, hey, I support RTP. Okay. Oh, I support debit pulse, but I won't do it. I don't recommend it. Like, if you go to, as an example, Chase, they clearly they have a pay by bank solution. Okay. But literally they say on their website that, oh, it is high risk, don't do it. Like, counterintuitive to what their actual product is. So till we get alignment across the industry, I think all these companies like ours can do is like work within the ecosystem. And to me, like, frankly, it's like band-aids. I personally wouldn't say that, oh, there is something that somebody has done so dramatic that it's so cool or out of the ordinary. It's just working in the confines of the unfortunate ecosystem we are in.
Got it. Sorry, I've been asking a lot of questions, Agam.
I just wanted to, look at the time. It's almost an hour for now. So just to wrap up things, like, just to get a gist of what do you see in future coming in for next 4 years, 5 years in the payments industry or in the fintech world. I know it's been going in a fast pace right now with all the new things coming in, new interesting startups coming in. What other trends do you see, like, if AI is going to come in, or what it's like to just to envision, like, how the industry is going to look like in 5 years?
Yeah, I'm personally very optimistic on where this industry will be in next, not even 5 years, like next 2 to 3 years. I think CFPB is giving in a lot of guidance around open banking in general. I think there will be consolidation. Like, invariably, the banks will realize that it is not cost effective for them to manage these multiple rails. the banks are involved in all of them, like whether it is Zelle, whether it is RTP, whether it is FedNow. So I see a lot of consolidation happening. I think banks will come to a conclusion that they need to consider a lot of the things that have happened in the past as sunk costs, bite the bullet, and start working towards consolidating. Otherwise, it won't sustain itself in the long run. So I definitely see a consolidation happening on the Rails side. I also see a lot of, well, I'm not necessarily on the AI journey or AI board just yet. I see AI playing a big role in payments fraud mitigation, right? Big, like even when we talk about RTP, FedNow's irrevocable funds, fraudster will figure out a way to commit a lot of fraud on those rails. So I do see AI playing a key role in fraud mitigation. If in next 2 to 3 years we can get those things done, I think it would be a huge win. And I do see that coming, just because one, on the cost side of managing multiple rails, and also like nobody likes fraud. And I think the fraudsters are getting sophisticated, but so would the AI models, ML models. So those two would be the ones I think we'll see a lot of traction. And I'm really hopeful that that's going to happen.
Do you, I mean, we didn't mention crypto in this at all. I guess last question for me is like, do you see a future for that? Is that like something that you feel like is just another patchwork for like issues, I guess, with money?
You know, today I'm a regulatory guy. I think if there are regulations, crypto is there to stay. If in the absence of regulations, it's gonna just explode big time. Like all these FTX issues it didn't serve anybody well. I see a lot of interest in crypto, and not just in millennials, like across the different demographics. But the only way it can survive is when there are clear-cut guidelines on how crypto industry should operate. It cannot be on the periphery of, oh, we gave some guidance. It cannot be, oh, we filed a lawsuit against this FTX guy. Like, no. Companies are exploding. Like I know several executives from Visa who left their high-paying jobs, started a crypto company, were relying on FTX, and boom, everything is dust, right? And they are lacking confidence now. Like as I talk to them, their thing is we need clear regulations. If like my hope is that there would be clear-cut regulations around how this crypto industry needs to be governed. It cannot be loosey-goosey. It has to be black and white regulations. Then only it can survive. And if clear-cut regulations are there, then all the institutions like banks would jump onto it. There's a lot of money to be made in crypto. A lot of money to be made. And we are talking like 100%, 200% returns in a matter of days and months, right? It's just not regulated. Like 99% of crypto is scam, even more. Regulations can help. They need to help, right? Otherwise, it's a gamble. As of today, crypto in my mind is a pure gamble. So regulations is the key for crypto as well.
Really, really good advice. Really, really good advice. Well, thank you so much for being on the podcast. This was an amazing episode. I actually learned a ton talking to you. I feel like years of experience. So I feel like it was eye-opening to see your perspective and to hear like what your thoughts are on the industry. And I do think that change is possible, and I think it's exciting to hear like your thoughts on it, honestly. I wanted to say thank you for being on the podcast and being here, and I feel like it was really, you went deep into like why the US is the way the US. It's interesting stuff. So
yeah, and frankly, Daniel and Agam, I appreciate the opportunity. I think we all are payment nerds. We want to better the industry, and sometimes it can feel like a Herculean task. And like what I tell my guys here is, let's just keep moving the ball forward every day, right? And we have to be optimistic. We have to be hopeful that things will change as long as we keep talking common sense, right? So I'm glad that we were able to sync up and have a conversation, and hopefully we'll do more of this in the future.
Thank you so much, Rohit. It was great to have you. This is really great. Thank you so much.
Thank you, guys.
awesome. Thank
Thank
you.
you.